On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. A warm welcome to you folks. This is the On the Tape podcast. I'm Guy Adami, always joined by Danny Moses and Dan Nathan. And today we're going to be joined by Luke Gromen, founder of the firm Forest for the Trees. That's a great conversation, Dan. And just give me a second here, because we're going to talk about some individual stocks. David Einhorn, somebody in our world, made some comments about the market. China continues to sort of melt down. Some of these large, big cap semi-names continue to skyrocket. Danny Moses has some thoughts on some dividend payers. But Luke was last on October 20th of last year. October 20th is a day that lives with me because on October 17th, 1977, Leonard Skinner released Street Survivors. Great album, last studio album. And obviously on October 20th was the day that their plane crashed in Gillsburg, Mississippi, killing Ronnie Van Zant, Steve Gaines, Casey Gaines, Dean Kilpatrick, and the pilot and the co-pilot. I digress. But Luke was on the 20th. He actually knew that. And some of the songs on Street Survivors resonate with me because one of my favorite songs, Dan, is I Know a Little. And I got to tell you something, folks, if I'm putting it out there, I know a little about the stock market because what's going on not only over the last year and a half, 2 years, but just the last couple weeks has been death-defying and has left me sort of in the fetal position, Dan Nathan.
Yeah, so it's interesting. I think that what you mentioned is, David Einhorn, a famed value investor, Greenlight Capital, was on the Masters in Business podcast on Bloomberg that dropped on Thursday, the day that we are recording this. And the headlines that, I like immediately shot it over to you because I know that you don't have your podcast player up and ready to go all the time.
No, it's unfortunate. My favorite podcast
store it was closed today. But here's the deal. So some of the headlines that kind of caught my attention: passive investors have no opinion about value. They're going to assume that everyone else does their work. So he was kind of talking about market structure. He was talking about passive investing. These are things that you guys have talked about a great deal. I view the markets as fundamentally broken. Value just not a consideration for most investment money that's out there. And so, when you start hearing that sort of stuff, and this guy has had 2 great years. I think he was up 36% in 2022, and he was up 20-some% last year. There are not too many long short folks in the hedge fund community that were actually up both of those years. Danny, so when you hear that sort of stuff, as long as you've been in the business, David Einhorn has been, an important market voice. Is it kind of confirm some of the thoughts that you've had about some of the wacky action that we've had in the markets over the last few years?
I know a little. Yeah. So
by the way, before you even, the piano solo in I Know a Little from Billy Powell is unbelievable. Now, if you don't know who Billy Powell is, shame on you. But Billy Powell was a roadie for Leonard Skinner. And one day, Ronnie Van Zant heard him playing the piano before a show. And he's like, holy shit, you can play. So he went from roadie to keyboardist of Leonard Skinner. Anyway, sorry about that. Danny, please.
Yeah, so Einhorn was pointing out just the advent of passive indexing, chasing indices, quants, all the stuff, that price discovery is really not there. And, that is a huge opportunity over the longer term for people that want to seek out good stories, certainly on the long side, that aren't in an indice or aren't over-owned or aren't over-covered by Wall Street. So, I've known David a long time. I think he's one of the smartest investors of our time. He was right there kind of with us, kind of the same mindset during the global financial crisis, certainly going after Tesla at times. I admire him for that. But I think when you see names like Eli Lilly, great quarter, move 10% on a $700 billion market cap on a good quarter and a beat, was it that misunderstood? Was it that misunderwritten? And when you see ARM, great, went public, last year at $51, up 60% today. That's $125 billion market cap. Again, good quarter, great business, all that stuff. But something's not right here. And what's happening is you have the haves and the have-nots. So you're going to continue to pay a premium for companies that are going to exceed or grow. And you're going to hammer the companies that miss. And I think what David's probably saying is that type of thing can't last too long. Value stocks that get beaten up will be bought at some point, and growth stocks that get over-owned will be sold at some point. And that's just it. That's the timing. But you need long duration of capital to kind of achieve that. So I think that's what he's saying. And that's kind of what you're seeing right now in the market. Is
but to his credit, he's embraced that and he's adapted to it, as opposed to somebody like a jackass like myself who completely understood what was going on for quite some time. I've said about passive investing for years how it was basically clouding the works, right? It was disrupting markets and you had no price discovery. Yet I wasn't smart enough to say, with that said, I'm no longer going to talk about those fundamentals because fundamentals don't matter, as David pointed out.
Yeah, but we're in the business of kind of demystifying, telling stories, kind of like doing, like at least using the tools that are in our toolbox, the things that we learned that were fundamentally driven, you know, when we started out in the business, and trying to help people kind of figure out this game. And make no mistake about it, it is a game, right? And so the game has changed. And just to quote The Wire, it's just gotten more fierce. Well, don't worry about it. But here's the deal, okay? When I look at, let's just look at one of these names. You want to talk about broken market structure. So ARM, okay, this was a company that SoftBank, you know, was spitting out in an IPO last fall at $51, okay, at $51. Today, as we are recording, the stock is up $41, okay? It is trading at $117, okay? So it's gained $50 billion in market cap. Now, you can go, and we'll put in the show notes, you know, the quarter that they reported, the guidance that they gave for just both this year and next year. And this is a really important point. Guy, you said this on Market Call earlier today. We had Rick Heitzman of First Mark Capital on the show the day it went public on Fast Money, okay? And you asked him, hey, listen, you know, you're like, this is, you know, a semiconductor licensing company. They don't even have a lot of the, you know, they don't have exposure to some of the areas that are the hottest things in the market right now. Are you concerned with the valuation? And I think he gave us an answer, something like, not concerned with the valuation, because most investors are not concerned with public market valuations anymore. And that is kind of what's broken.
Well, if you look at it again, and this is not to beat up on ARM, this is just an illustration of what's going on. Prior to becoming a publicly traded company-ish, they were doing about $3 billion, give or take, plus or minus $100 million or so a year. So pretty much flat revenue growth. They just guided full year 25 revenue. I'm going to round up and say $4 billion, although it was just short of that. At current value, at current stock price, it's trading about $123 billion market cap. So you're talking about a company now that's trading almost 32 times revenue, which is historically obscene. But going back to Rick's point, and then obviously David's point, clearly those things don't matter. People will say, Guy, it will grow into that valuation. It's really got to grow, and it's got to do something that it hasn't done over the last few years. That's in a huge acceleration of revenue, which we're not seeing right now.
But there's two things, Danny, and I want to get your take on this because you talk about the chase all the time, right? Portfolio managers who have to chase things. So this is actually not a function of passive investing, the thing that we're talking about. This is the function of FOMO, right? And this is a function of, let's just say, people looking at what happened in AMD over the last 4 months or NVIDIA over the last 14 months or something like that, and they see meaningful upward guidance on the out year. And you tell me, do they have the visibility on 2025 right now? You know what I mean? That's causing investors to pile in. And this stock at one point that's now up, you know, 53% was up 60%, you know, earlier in the day. That is pretty unnatural. And those are two very different things, the passive flows versus the FOMO flow.
Yeah. And I would say the irony is here, the larger the market cap, the more outsides move that you get because of that exact reason. If a stock is in the top 20 or 30 of an index and you're judged against it and you don't own it from a market weight perspective, you get hammered. So it actually is self-fulfilling. If this was a 2 billion market cap, I have a hard time seeing it going to a 3 billion market cap, you know, on the same size and same news because of what you're going to see. So yes, we've seen the chase. It's been seasonal at times, beginning of the year, end of year, and so forth. And it's kind of obvious, but it is what it is. So you have to play the game that way. You have to kind of respect it. And you know, there's a lot of factor momentum or whatever these guys use and these quant funds use. And the newest one, or the new sexy one, which was the least sexy thing in the markets for a long period of time, is dividends. And even companies that pay a dividend, raising their dividend. It's like I've always said, earnings are a beauty pageant. And if you can come out of the beauty pageant and add some extra stuff like a dividend dance, guess what? You know, you're gonna get more eyeballs on you. So something I think we should really talk about, because there's been, you know, a huge diverse move of companies cutting and raising dividends here.
Yeah, sure. But I guess on the strength side, so last week on February 1st, the day after Meta reported their earnings, stock gapped up $20. And, one of the, I guess the headlines, normally you see when a company introduces a buyback guy that has not had that, a growth company, some people are like, oh, well, aren't there better uses of their capital than to be giving it back to shareholders, right? With Meta, it was one of those things, it's like, it falls into value, okay? If you think about it, it's trading at basically 20 times the out year. That's in line with the forward estimate for the S&P 500. Expected, double-digit earnings and sales growth, right? Really high gross margin. So it's value, it's growth, and now they introduced a $2 annual dividend, 50 cents a quarter. That's a minuscule, okay, dividend, but it does do something for an investor base, doesn't it, Danny? It kind of widens that base out a little bit.
Yeah, and there's reasons that companies are now instating that dividend or raising the dividend. And that's because, one, there is a very small kind of tax now on buybacks, very small. There's concern if you use your capital for M&A from the FTC that it could be blocked, right? So there's reason to kind of do it. And the other reason is certainly it gets in, talk about passive, gets in a lot more indices when you're paying ETF. And I would just note what we've seen kind of bigger names that have been in the news in the last few weeks. Walgreens Boots, WBA cut their dividend. Stock got destroyed. Why did they cut their dividend? Because they want to buy back debt instead of paying cash out, right, to shareholders. And NYCB, which has been front and center for many reasons in CRE. But when you look around and you say, all right, what is a good company that continuously raises the dividend that could surprise? Because now you have to start to think like that. And I'll go straight to Walmart. Walmart's reporting on the 20th of February. They just went a 3-for-1 stock split. Yes, it does nothing to valuation, people out there, stock split. However, I will tell you that the CEO of Walmart and Sam Walton used to say he wants his employees to feel like they don't have to buy fractions of shares when they go in and use their money to buy their own stock. So there is a psychological reason. However, Walmart has increased their dividend every year since 1999. I mean, you can't make it up. And so you see a name like that, guys, I'm telling you, ahead of this quarter on February 20th, if that's your game of investing, and our sponsor, CME, which is now literally a 5% dividend yield between the special. They raised their quarterly dividend today again, right? So you start to look at those names, and Hershey's, sweet chocolate. I mean, look at that stock today. It's up a lot on a solid dividend increase. So if that's your theme, and I want to throw one other at you here, which I think could be a negative catalyst, and then I'll turn it back to you, Guy, is Blackstone Mortgage Trust, BXMT, $3 billion market cap. They're reporting pre-market February 14th. This dividend is not sustainable. $2.48 a year. Their dividend payout is 217% of what they have. You're looking for an office property company, commercial property company that has exposure. That to me is really interesting. So if you start to look, if this is the new thing and you can find companies that are going to cut and companies are going to increase, as Dan says, have at it, people, because I think there's a lot of catalysts coming up in the market.
A lot of things to dissect there. But what I'll start with, Dan, much to your chagrin, I'm sure, is Danny just mentioned sweet chocolate. And of course, I think of the great band Sexual Chocolate, Randy Watson in Coming to America, if you recall. Brilliant portrayal. And the great Eddie Murphy, who is a fan of this podcast, no doubt, obviously is in the upper echelon of actors of all time. I could watch Coming to America on a loop, Dan Nathan.
Yeah, you could. It's interesting, though, that we're getting to a place right now that we're talking about catalysts for single stock trades or investing on dividends. And normally, if we were saying, I think the one that you mentioned, Danny, about cutting a dividend to kind of buy back debt, those are the sorts of things that actually might be perceived as pretty positively, right? Especially when the cost of of credit is risen so quickly and the like here. I mean, some of these companies were doing that pretty well when interest rates were much lower, if you will. We're just kind of at a weird spot in the market, and it goes back to passive is basically turning lots of fund managers who have benchmarks into FOMO traders right here and disregarding a lot of the things that we know will ultimately correct at some point, because you just can't have things go so far out of whack. Like we've highlighted this again, and I don't mean to kind of harp on this. And for some of you guys who think we harp on things too much, we were harping a lot on Tesla's fundamentals last year or the last couple of years. Well, the stock, has sold off because of its poor fundamentals, okay? And so when we highlight the fact that NVIDIA, since January 2nd or 3rd, has gained $850 billion, $850 billion. I'm just going to say that again so it can sink in. in that time period, in a month, because of what its customers have had to say, because of what its competitors have to say, don't think that it can't go the other way too, right? And so like that's kind of one of the reasons why if everybody out there has their pom-poms out, and we spent some time earlier in the week on Market Call on OK Computer. We'll put the OK Computer conversation I had with Deirdre Bosa in the show notes. We were highlighting a credit analyst over at Barclays had a sell NVIDIA note. This is not the equity analyst. There's not a single equity analyst who covers it on the street. And there are about 60 of them who rate the stock a sell, okay? So there is tremendous groupthink going on here, and it seems like a total disregard for a bear case that might just be early, just like the Tesla bear case was a little early, right? So I just kind of want to make that point because I think we're at a level of euphoria in the stock market when stories look good. We just highlighted the ARM that's trading up 55% as we speak. That just seems unnatural, Danny.
Yeah, listen, we talked about Tesla a few weeks ago, and I actually said there's no reason to own a Tesla when you can own a little Ford or GM and then a little NVIDIA or pick some other tech company that has AI. Because if your reason to own Tesla is not just the auto business, but their other tech business, which doesn't ever seem to get off the ground, then forget Tesla and buy these other things, right? If that's your viewpoint. But yes, it's not sustainable. And the problem with it is this is not about being bearish, people. This is being practical. I really mean that. And the problem is, what is your sell point? What is the trigger? What is the thing that has to happen to people to say, you know what, the momentum's over? And that's the scary part. What are you looking for? I mean, I asked Luke Gromen the question, you guys will hear it on the back half, is if he's turned a little bit bullish. I'm like, okay, what's the sign you're looking for? And so when things do start to sell off, you're going to want to own the names that can uphold and, kind of validate their valuation. And maybe that means down 10 to 20%. But you're right, Dan, some of these names, you have the risk of down 30 to 40%. And, again, just diversify. That's all we're saying. It's not about selling everything.
I'm with you. And it's interesting because if you believe that, we're getting, again, ahead of ourselves in some of these high-flying names, you say, guy, well, where would you be? And I'll tell you, I'll continue to say that despite the fact that some of these big-cap integrated names have done nothing over the last month and a half, 2 months, actually some of them gone down, there are other downstream names that have done extraordinarily well. And a lot of these names report in April, a name like Phillips 66, for example, which has been on fire. We've talked about Marathon Petroleum, MPC, a number of different times. So there are names that work. And the one that I've talked about for a number of reasons and really has this stealth rally off the lows has been Valero, which is we're sitting here today, is trading north of 140 and was within earshot of its all-time high. So despite the fact that energy's sort of been left on the wayside, Dan, there's still a lot of stocks in the energy space that make a lot of sense.
Yeah, and you've highlighted a bunch of those names. You've highlighted the potential for M&A. It seems like there's a new deal every week, okay? So that should kind of put some upward pressure on the space. Now, I know, Danny, this is a space that you've liked also, but one of the things that really kind of troubles me a little bit, and this is on a week where the Shanghai Composite has had a really nice run. I think it's up 8% or so from, I think, probably close to a 10-year low. It kind of matched. It was definitely below the pandemic lows, and I think you have to go back a while. We know that there's been a bunch of movement there on the regulatory front and on the the stimulus front and the like here. But you see those numbers out of Alibaba the other day, and the stock sold off, I think, probably 10% in the last couple of days based on that. And you say to yourself, some of the news about deflation, some of the news about the commercial real estate bubble that we know has been unwinding over the last couple of years that people had been warning about for a dozen years. You know what I mean? It seems like the deflationary spiral that they have going on over there at some point is going away on the rest of the world's economy. And it just like I've been mentioning that for a while. I'm not an expert on China. I'm certainly not an economist, but it seems like right now we have a 10-year yield at 4.15% because we're worried over here about inflation reigniting a little bit, right? Maybe the gains that, the Fed Chair Powell has talked about, that he still does not have the confidence to tell us when he's going to cut interest rates because they've come down, inflation's come down enough. I think we're in this really weird, Danny, push and pull between what's going on in China. We had 3.1% GDP growth last year, and I think China's was what? 4.5 or something like that. Its lowest in 30 years or something like that. And you say to yourself, 4.5, that's great. No, that's not great. I mean, 5 years ago it was 10% or something like that. You know what I mean? So I just think that like there's something going on in the global economy. And right now, I think the U.S., it feels like, I don't know, it just doesn't feel as good as 50-year low unemployment, consumer confidence really high, stock market at all-time highs, wage growth pretty good. Like all these things are screaming strong economy.
Right. Yet meanwhile, if you poll people are so down on the economy when they're asked about the economy. The president's approval ratings when it comes to the economy are probably at historic lows in the face of everything you just talked about. And there are reasons for that. But getting back to the China thing, the decoupling between China and the global markets started somewhere in the middle of 2022, and it's been severe. So the question one has to ask themselves is China going to catch up and reaccelerate and catch up to the global economy, which is effectively the United States and Europe, or is the rest of the economy, the rest of the global markets, going to catch up to what's going on with China? That's the bet right now, because this divergence is not going to continue, Danny.
Yeah, there was the lowest CPI print since when? September 2009 over in China. And I think what we're seeing here, and when you look in the U.S., again, the haves and the have-nots, I mean, you look at the credit card debt hitting new highs at 1.13 trillion. 1.13 trillion. Delinquencies up 50% in 2023. Serious delinquencies, the highest since when? 2009. That doesn't affect, obviously, the people that are maybe investing in the stock market per se. But when the average interest rate on credit card debt is 20.74% or something like that, obviously it starts to eat into people's wallets. And I think, Dan, you just described a situation that we've been talking about now for a couple of months, that the U.S., at least part of the U.S. stock market, is the sexiest game in town. It looks great. It's growing, and it's narrowing into these names. And yeah, you get to add a few names every other week. It feels like, let's throw Lilly in, let's throw ARM, let's throw some of these other names that start, to chase. And you are seeing some names fall out of favor, like we talked about before with a Tesla and an Apple, which is on a relative basis is not performing. But I think that's really what it is money trying to find a home where there's growth. China is going into the Lunar New Year. What is it? The Wooden Dragon. I think it starts on the 10th of February. So they've done a lot of things in preparation for that to kind of just clean the slate, a new financial regulator to set the table, I think, for these kind of next 2 weeks so they can kind of start over again when they come back. But I just think it's just money trying to find a home. And when you use valuation as a reason to short, it can take a long time. So obviously wary of that as well.
Yeah. And again, I've said this a bunch over the last few months. I feel like the last few months felt a lot like late 2021 in the stock market. There was still a lot of enthusiasm, but under the hood, there was a lot of stuff that wasn't acting particularly well. Some of the data that we're starting to see, that was the post-COVID kind of bounce, was starting to moderate a little bit. Some of the comparisons were going to be getting a little tougher. I kind of feel like we're there right now, but the disconnect between what all of those, data points we just highlighted about the economy, like we had an economy that grew 3% last year. Nobody expected that. Most people coming into last year, and we've talked about this at length, were expecting a recession at some point. Well, the Fed in mid-December, they told us they're expecting 1.4% growth. That would be cut in half, right, from the growth the unexpected growth that we had last year. And I think, Guy, you're alluding to this article in the Wall Street Journal that really caught my eye. And it gave a lot of examples that makes you kind of think a little bit about the data that we're seeing, the headline data that we're seeing, and say, is this really, what's going on? It was, I think, on Wednesday or so, why Americans are so down on a strong economy. I mean, the Biden administration, when you think about all the fiscal stuff they put in place, you think about where wage growth is, you think about where unemployment is, you think about, obviously inflation. I think people are still stuck with food prices and the like here, but, gas at the pump has come down a lot. And there's just this huge disconnect. And again, this is obviously an election year, and we're going to have this going back and forth. Republicans are going to try to make the economy sound absolutely horrible, right? Democrats are going to try to make it sound at least as good as the headlines show it to be. But I don't think this is going to get better anytime soon. And the last point I'll just make here is that as we get into the 1-year anniversary of SVB and First Republic and all this sort of stuff, at the end of the day, man, what are the surprises that could actually decelerate growth? We keep hearing from some of these consumer companies and some of these fast food companies and digital ad companies that the war in the Middle East has suppressed demand. Well, I don't know about you guys. The war in the Middle East seems very contained right now, at least between Israel and Gaza, and obviously what's going on in the Red Sea. That has potential massive implications as far as inflation and supply chains and the like. And obviously the bombings that have gone on in Syria and Jordan and Iraq by us and the UK over the last week kind of hint to something huge. But by the same token, something bigger, I mean, but by the same token, there's a lot of talk of a ceasefire. So, like there's lots of things out there that could cause the economy to slow meaningfully.
Yeah, it's interesting. McDonald's, obviously the top of the food chain, no pun intended, but one of the things that the pushback is their prices are too high. So think about that for a second. When you hear from a McDonald's, and that sort of dovetails what you heard from Dollar Gen a year and a half or so ago, people are trading down. So why are people pissed off? I'll tell you why. Because they say, I watch television, they tell me inflation's going down. And they know it's not going down. It's going up less fast. And that's what people are doing. Right now, people, Danny, are combating inflation using credit. And now consumer credit, consumer debt in this country for the first time is north of $17.5 trillion. You outlined credit card debt being $1.13 trillion. And I think the average rate, not that it matters, is closer to 21.5%. That's the problem. That's why people are pissed off. And that's why we can hear about GDP and unemployment rate below 4% till the cows come home. But people feel like they're put in a corner and they can't get out of it vis-a-vis the wage growth, which is there, but clearly they're not keeping up with prices.
So we just mentioned, obviously, we're coming up on the regional banking crisis of last year, right, where we saw, some of the biggest banks since the financial crisis go under. And it's kind of interesting here as we're almost anniversarying that. If we think of like one of the concerns was obviously commercial real estate, the debt that some of these banks had held because of, the kind of disruptions that we had last year, and obviously the weakening, commercial real estate market, not just here, but obviously abroad. It's interesting, Danny, and Guy and I spent a little time talking about this earlier in the week. Look at how Carlyle is trading. Look at how KKR is trading. Look at how Apollo is trading. So some of these private equity companies, they're blowing out. They're making new 52-week lows at a time where the money center banks have just stalled out. Mm-hmm. The KRE, which we talked about, the regional banking index, has come off and has actually broken the uptrend that it's been in from the October lows or so. So it's interesting when you think about exposure to commercial real estate and everyone's been waiting for another shoe to drop, you know what I mean? And I think that kind of your antennas got up because you heard Treasury Secretary Yellen talking about commercial real estate the other day. And so it's kind of interesting that like what these private equity companies are doing in the public markets right now and what we think of some of the risks that exist and probably on their balance sheets as we've seen this huge push into private credit also.
Yeah. So Dan, as it relates to these large private equity companies, obviously they all have exposure to real estate. But as far as a large percentage exposure, they don't have it. You do see pockets of it, which you've seen at Blackstone. Obviously BREIT, and then now what I've talked about in preview, this Blackstone Mortgage Trust, which is going to be reporting next week. So I just think as far as how meaningful it is to those companies, I just don't think it's as meaningful as we've seen in some of these regional banks, most notably recently NYCB. Yellen's testimony that she gave before Congress these past few days certainly highlighted that they're watching it, they're aware of it. They're not saying as far as say it's contained, but they're saying that they think that we can deal with it. And we get news every day. And we had this private bank in Germany, I won't try to pronounce the name of it, that the bonds got crushed based upon a report by an analyst talking about their exposure to commercial real estate. And so I think we're going to keep seeing this stuff occur. And maybe at some point it'll matter, but it feels like slowly, and then maybe all at once. So hopefully there's not a high profile blow up that goes on here, but it certainly is on people's radar screen.
Look, New York Community Bank, I think, had $100 billion worth of assets. So in terms of market cap, it might not be a big deal. In terms of assets, I mean, that's not insignificant. And again, it might be specific to them without question, but it doesn't mean other banks don't have similar problems lurking around on their balance sheets as well. And, one of the things, Dan, we talked to Luke Gromen about, and I don't want to get too in the weeds here, but a rising dollar is something not a lot of people are talking about enough. And dollar yen, for example, which peaked, I want to say, Danny, around November 10th, north of 151, traded all the way back down to 140. Very quietly, nobody talking about the fact that dollar yen is now north of 149 yet again. And that strengthening dollar becomes a bit of a wrecking ball for markets. So keep an eye on what's going on with the dollar as well, because I don't think that's being reported enough, Danny Moses.
Yeah, well, you had a little bit of news out of the BOJ saying, well, they're probably going to end NIRP. They're certainly not going to do anything more than that in the coming months. So I think that was somewhat of a dovish, which obviously makes their rates go lower, which makes their yen weaken, et cetera. So yes, on the margin, this dollar, certainly the risk, and Luke Gromen, to your point, talks about it. Dollar running away and higher is certainly a risk to the equity markets.
It's absolutely shocking to me, though. Again, we have a 10-year 4.16. We have a U.S. dollar index. The Dixie at 104 is up from 101 or something like that. We have an S&P basically at all-time highs, and we go back to the valuation. I mean, when you think of the input costs of higher dollar, we heard a lot of commentary on Q4 earnings and guidance about currency adjusted and this and that or whatever. Especially when companies miss, they were blaming it on that. Apple certainly did, right? You think about all that and just the disregard for those sorts of inputs, because when the market was screaming into the end of last year, right, like the consensus was that we were going to have 5 or 6 rate cuts, right? To me, the fact that those have been cut in half and possibly pushed out, right? I just don't understand how, and I know I sound a little ranty right now, but I just don't understand that there's absolutely just total disregard for that. So the level of complacency at a time where we're seeing really funky price action. And again, you know what? You could point to Snap. It lost 35%. Air Products, chemical company, got nailed after their earnings. There's probably a couple others that got hit really hard, but none of them are particularly significant. When you think of the market cap gains that we have seen from some of these biggest names when they blow out, ARM today, $50 billion, like that is it's a little insane, guy.
That's what everybody is focused on. So when you have, Danny said beauty pageant before. I mean, in terms of stocks, it is a beauty pageant. So you're going to find the most attractive stocks out there. You're going to hone in on them, and you're not going to look at some of the, I don't want to say devastation, but some of the problems that are below the surface that nobody wants to seem to bring up, because the S&P at 5,000 effectively masks everything. By the way, we listen to a lot of podcasts here on the On the Tape podcast.
Well, I do.
You've stumbled upon one recently.
Yeah, so we have a new partner at Risk Reversal Media. That would be RBC Capital Markets, and they're going to be sponsoring a new podcast series on OK Computer called Funders and Founders. It's going to be hosted by me, and we are going to put together some private tech market founders and some VCs that funded those companies. We're going to talk about their origin stories, how they work together over the course of the company's growth, and what their kind of plans for exit and the like are. So that's going to be a great series running on the Risk Reversal Media OK Computer feed over the next couple of months. But the other podcast, this is from RBC Capital Markets. It's called Strategic Alternatives, where they're experts, they're bankers, they're capital markets folks. They turn on the mic and they give the listener a sense of what they're seeing in the markets. Are we going to have M&A, strategic M&A? Is it going to be financial M&A? Is it going to be IPOs coming back? Are there going to be secondaries? What's going on basically in the capital markets? So that's a great podcast. I've been listening to it for a while. I know a bunch of their tech bankers. I know a bunch of their equity capital markets people, and now they've partnered with us at Risk Reversal Media. So be sure to check out Strategic Alternatives wherever you find your podcasts.
Everyone should listen to Strategic Alternatives by RBC Capital. I goof around and say I don't listen. I actually do. You will get a lot out of it, and we're happy to be partnered along with RBC. By the way, the great Halima Croft works at RBC.
And our friend Lori Calvasina.
As well. We have reached the final week of the NFL season, the league where they play for pay. The Chiefs of Kansas City playing the 49ers of San Francisco. Danny, I think you come into this week a robust 32-25, if I'm not mistaken, which is a serviceable year, if not a very good year. But before you give us your pick, you have some thoughts on what's going on, again, below the surface in this whole sports gambling arena.
Well, yeah, you're just seeing the convergence of kind of sports and media and gambling. And when you see the news come out yesterday that blindsided the leagues and blindsided certainly Fubo, right? If you look on the media channel there, Disney, which owns ESPN, and then Fox, obviously sports, and then Warner Brothers, which is Discovery, are partnering up, right? And they each have rights to some of these leagues, and they're going to distribute live sports how they see fit. Let's just put it that way. And so the cable companies certainly are getting more ancient by the day. The leagues themselves didn't even know about it. They said they certainly want to make sure that it's being distributed appropriately, which I'm sure will be. But this seems to be the trend. And when you think about the value of some of these sports teams, which we've seen, don't tell me that they're not enhanced from all the gambling, which obviously creates more eyeballs. You look at the Orioles sale, which just occurred, I think it was $1.7 billion, whatever it might be. So the trend here is the convergence of kind of sports and gambling and media, and look at the performance of these sports gambling companies as we head into the Super Bowl. Look at DraftKings, right? Stock is completely in a breakout mode here. I think north of $43. Genius Sports, which I've talked about at times, which is kind of the B2B provider of data, which licenses data from the NFL to create in-game bets. Flutter just listed, a couple of weeks ago on the New York Stock Exchange, FLUT. These things probably still have a little bit to run. Now, they are seasonal to a degree. They used to say buy the home builders after the Super Bowl. Maybe you sell these things after the Super Bowl. I don't know, but certainly something to keep an eye on. So listen, I have said for a long time that whenever Patrick Mahomes is an underdog, you just take him, right? And I've ridden that through this season. And the Chiefs are catching 2 points. San Francisco, I think, is absolutely the better football team, but you have to assume if you take him, that Brock Purdy, the quarterback of San Fran, is not going to make any mistakes. And I just think he will. And I got to just take the Chiefs +2. I don't love it. But what I do love is the over, 47.5 points. I actually think this game's going to be a shootout. So I'm giving out, which I haven't really done, via Super Bowl and over-under. So I'm going to take the Chiefs, but somewhat as a hedge, but someone I think I can win both, is to take over 47.5 points. So that's it. I got hot at the end of the year. Let's see if it continues. I took the Chiefs last year in the Super Bowl as an underdog under the same theory and loaded up on them at halftime then as well. So those are my 2 picks here, boys.
Fast track, I agree with the over. I'd love to see the Niners win for a myriad of different reasons, Dan, but you know what? It's really painful. It's like betting against NVIDIA. It's effectively what you're doing when you're betting against the Chiefs.
All right, Danny, I'm not sure if you're going to like this. But I'm also taking the Chiefs, getting 2 points. And I like the over. I wasn't even thinking about the over until I got so you and I, we're locked in here, buddy. All right. So we're going to end the 2023 season on the same note.
Wonder Twin Powers activate. Form of us both winning the same bet. Let's see if we can pull it off.
All right, fair enough. And listen, I am very glad that you had a late season run here in the playoffs. You really actually caught steam at the right time. So there you go.
Stick around for our conversation with Luke Gromen. You're not going to want to miss it. Well, welcome back to the On the Tape podcast. Now, this next guest last joined us on October 20th of last year. And we actually talked about the significance of that date. That's a rock and roll thing. However, the significance of that date also coincides with effectively when yields were at their zenith within a couple weeks thereabouts. So Luke Gromen, the founder of unique macroeconomic research firm Forest for the Trees, joins us again. Luke, how are you?
I'm doing great, Guy. How are you doing today?
Well, that's another story for another time. I'm fine. I'm a bit exercised, but I'm thrilled that you're joining us again. And as I mentioned, listen, October, November of last year, yields, 10-year yields were going effectively from 4% up to 5% in a straight line. We've obviously seen a lot happen since. So from October till now, it's sort of a 30,000-foot level. What are your thoughts on a lot of these happenings?
At a 30,000-foot level, I think we have seen a series of steps taken by U.S. policymakers to essentially relieve the stresses that we were seeing at the long end of the Treasury curve at that moment in time when I was last on. So as when I was on October 20th, we were probably several Fed speakers deep into, I want to say like October 6th, you saw yields really get away from them over the next 10 or 12 trading days. 7 or 8 Fed speakers came out and they all said basically the same thing, which was the bond market is doing our job for us. So I took that as, okay, the Fed all of a sudden is starting to jawbone the dollar down. They're trying to jawbone financial conditions looser, which we're tightening very rapidly with that move in the 10-year that you were talking about. And then paired with that, I think arguably more importantly was Yellen on the October 31st or November 1st, whatever it was, quarterly refunding announcement. She surprised basically everybody by shifting issuance from the long end to the bill market in a much more pronounced fashion than most of the people that pay really close attention to that were expecting. And essentially, basically, that meant that she was funding the government out of the reverse repo program, which was basically just QE that had been done in the past and sterilized in the reverse repo program. So it was sort of stored up QE that we put in the reverse repo program and began bringing out of storage to finance bills to kind of take pressure off the long end of the yield curve. I think it's really important, those two things together, the Fed jawboning and what Yellen did. If you look at what the effects of nominal outright QE is or was historically, it was softer dollar, loosening financial conditions, a net reduction in long-term duration supplies, long-term treasury, and an increase in bank reserves. And if we look at what the effective result of what the Fed did with the jawboning, followed by what Yellen did with shifting issuance to the front end and basically financing the government through November, December, and into January out of the reverse repo program in some significant way, the effects were the exact same as QE. Bank reserves went up, right? They came out of reverse repo, spent into the economy. They end up in the bank reserves. So bank reserves go up, financial conditions loosen, the dollar softens, net duration supplies are reduced somewhat, not by the Fed buying them, but by Yellen just never issuing them. And so what we had was the liquidity response across markets, across financial conditions, November, December, into January. And I think that brings us to where we are from a 30,000 foot view into what we just went through last week with the quarterly refunding, where now we've kind of taken it in the other direction. Yellen surprised me that she didn't keep this going. She actually increased duration issuance, so shifted some back to the long end, quarter over quarter. All else equal, that's dollar positive, risk negative. You had Powell come out, and after sort of, he was tighter policy in October, looser policy in November, December, tighter again, obviously twice last week. He sort of talked markets away from a tightening in March. And so he's kind of reversed as well. So there's, I think, sort of a tactical way to look at what they did last week and over the last couple weeks, or I assume over the last couple months. Looser in October, November that we benefited from, tighter tactically in response to what they just talked about last week, Yellen and Powell, with the latest quarterly refunding update and then the Fed meeting last week. But if we take a step back strategically, this starts to look like sort of yield curve control without calling it yield curve control. Like we're micromanaging financial conditions by jawboning, by the issuance schedule. Okay, we needed them looser to contain the long end back in November. Great, we did that. Okay, now Wall Street's taking it too far the other way. Conditions have gotten too loose. Okay, 10 years down to 3.75. This doesn't help us either. Curve's really reinverted. Okay, let's start sticking some more supply at the back end. Let's have Powell tight. So it's tactically, it's not great for risk. Strategically, to me, it's actually really good for risk because you're seeing sort of yield curve control light type actions continuing without them having to call that. So I'll pause there. That's my 30,000 foot view since we last talked.
Okay. I've been waiting to do this since I knew you were coming on a few weeks ago. Luke, we've lost you from the dark side. So we've lost you from the dark side. What Yellen did, in my opinion, was a Jedi mind trick. So that's all the Star Wars I have for you. Don't worry, guy. We won't go down that rabbit hole. Here's my issue, Luke. So your thesis, and I was in your camp. You'll be back in the camp someday. But the part of what you thought that the market or the economy was going to go into recession was based upon, and correct me if I'm wrong, that the bond market, the Fed would lose control of the bond market to a degree, and that prices would sell off, yields would go higher, and that would cause, and we've seen iterations where we got to 5% on the 10-year. You can see what happens, things start to break. So that was your thesis, if I'm not mistaken. And you had to know, or now you're convinced that the Fed will be there, the Treasury will be there at every step of the way to massage any of these issues that may occur that may cause that. So your thesis is somewhat technical or artificial in the sense of, we kind of all knew the Fed was there. The bulls in the market, right, that believe, hey, don't fight the Fed, they're going to be cutting, they're going to do whatever it takes. That moral hazard thing is back, obviously, into the market. Is it that simple now, just in terms of just ignoring the stuff? Because let's be clear, if Yellen had made those announcements like she did at the end of October, beginning of November, and the market didn't react positively and yields kept moving, you may have a totally different narrative right now, is that people are seeing how big the deficit is, how big our debt is. It's just a fly on an ass. You know, it doesn't matter. So I threw a lot of stuff at you, but bring me back here and tell me where I'm not being correct or in your mindset here.
For me, I think my North Star in all of this is Treasury market dysfunction will not be allowed, full stop. It may be allowed to start, but it will not be allowed to persist. And we have seen that repeatedly, I would argue, since at least September 2019 with the repo rate spike, right? That was, yes, there were regulatory issues. End of the day, too much supply, not enough balance sheet. Repo goes to 8 to 10%. Fed steps in 48 hours, reverses 2 years of balance sheet reduction in 48 hours. That was the first clue in my view. We saw it again in March 2020 when the Treasury market at the lows crashed with the COVID crisis. We've seen it September 22, March of 2023, BTFP, which was banking was a symptom. It wasn't a banking issue. It's a Treasury problem because banks have $4.2 trillion of Treasuries and mortgage backs they can sell. In fact, that they were encouraged to buy by their regulators so that they could sell for liquidity. But now they don't want them selling that for liquidity because they're going to contribute to what is already $2 trillion in net issuance plus $9 trillion in refinancings that needs to get done this year. And so my North Star is Treasury market dysfunction will not be allowed to persist for very long. Okay, what's Treasury market dysfunction? I would argue it is, I think we've talked about this before, forget about what I would argue. What we have seen has been whenever the Treasury Move Index by Harley Bassman hits 130 on the upside, more dollar liquidity comes. It's within weeks, if not days, like clockwork since 2019. And so that is my North Star. Ultimately, you can see what this has been good for. It's been great for gold over TLT, right? If you look at the pairs, GLD over TLT, since 2022, boom. Bitcoin over TLT, boom. S&P over TLT, boom. S&P industrials, even getting away from sort of the very narrow market that we're having, that S&P might not be a great metric, which is something I tend to agree with. Okay, let's look at the S&P 500 industrials. Boom. It's the same chart. And the point here is to me, the trade is 60-40s dead from the standpoint that the fiscal situation of the U.S. is such that if enough dollar liquidity is not supplied, TLT sells off more than gold. It sells off more than stocks. It sells off more than industrials. And if we go back then to my North Stars, they're never going to let that happen for very long in the world in which we are in an election year, et cetera, then they're going to supply the dollar liquidity relatively quickly. And those pairs will work by the numerator going up more than TLT. And that's my core view.
So we can ignore our debt for now, fair. We can ignore the deficit, fair. But on the margin, again, we're not talking about a huge difference in terms of the tenor, paper being issued. I would actually argue that while they're preparing to stop quantitative tightening, that there was an opportunity here with less issuance being done at the longer end of the curve to actually start outright selling some of the Fed's balance sheet. Obviously, God forbid we ever even discussed something like that, right? I mean, we're not under 7 trillion yet, but hey, instead of just not reinvesting, let's go sell 200 billion of it, or 3 if there's such demand out there. So I guess my point is, what is it going to take, or what do we need to look for if you're bullish and people are bullish on the market? What is your number one warning sign? Is it just rates moving up? Is it inflation prints that start to come in higher than expected, and people start to panic that the Fed's going to either have to not be able to cut or going to have to raise? What should people be watching that are out there that are bullish in the market?
They should be watching for a sign that Powell and or Yellen are willing to stand aside and let the Treasury market defund the United States Defense Department entitlement obligations, and let a treasury auction fail. If you get a sense that one of those three things are going to happen, holy cow, look out. That's going to be this really, really bad stock market environment. The reason I bring those three things up is when you look at what the U.S. government spends money on, it's three things, right? 125% of receipts right now are entitlements, defense, interest. So yes, they can, if they were to outright sell, to me, I think the reason they didn't outright sell is a dog that, it's a case of the dog that didn't bark. They didn't sell because it can't. The long end, the depth of the long end is a myth. It isn't there. And a lot of the things we've been watching them do with all of these mind tricks they refer to, which I don't disagree with, are sort of, this is not the fiscal crisis you're looking for. This is the deepest and most liquid market in the world, right? It's, it's bullshit. Excuse my language. But it isn't, because otherwise they'd be doing what you're saying, in my view. If, Powell had the chance to do this, right, in last March, fine. Listen, banks, we told you to buy high quality liquid assets, 2014, 16, 18. We suspended the SLR regulations in March 2020 to basically buy more treasuries on unlimited leverage. And when we regulated you into this a decade ago, it was so that in a crisis, you could sell these things because this is the deepest, most liquid market in the world. Okay, the crisis is here. We're trying to unwind our balance sheet. Commercial real estate has issues, blah, blah, blah. Powell had every ability to just say, you know what? Great, Signature Valley or Silicon Valley, Signature Bank. Sell them, sell treasuries in a treasury sell-off, raise the cash to pay out the dollars. If you're upside down, then you're insolvent. Great, then we'll wind you up. We'll fire your management. The bondholders will own the bank. We'll wind this thing down like you're supposed to wind banks down and companies down in capitalism. And run the and oh, by the way, everybody over 250,000 in deposits in those banks. We told you that those were only guaranteed up to 250. So Oprah with your 800 million in it, whatever she allegedly had, sorry, it's gone. It's gone. If you see a sign that the Fed is willing to stand aside and let that happen, or when you look at the U.S. fiscal position and the amount of cuts that you would need to sort of sustain or get the deficit back to sustainability, if you're not going to cut rates and reduce interest expense, right, of our big three, then you're looking at 30 to 40% immediate and permanent cuts to entitlements and defense, not someday, now and forever. And that's just to kind of get it back to like a 2%, 3% of GDP deficit. And that also sets aside the fact, it's not even speculation, the fact that cutting those line items, because they're so big, would actually drive a recession and the deficit would actually increase. So you'd go into a spiral. So the bear case on the economy, in my view, the bear case on the market is that Powell and or Yellen are willing to stand aside and defund DOD in the middle of what we're going through in Gaza, Red Sea, Taiwan, etc., in an election year, unlikely, or slash entitlements in an election year by 30 to 40% forever, unlikely, or is willing to stand aside and let Treasury market dysfunction get to the point where we have a Treasury auction failure, which sounds crazy until you take a step back the first week in November and realize we had a 5 basis point tail on a 30-year auction. Like, it's not inconceivable. Like, wait, let that thing get to 10 basis points, 12 basis points, 15, effective failures of an auction. If they're willing to do that, that's terrible for risk assets. And then again, 10 basis point tail, and the Fed says, we're going to sell 200 billion next month, or another 100 billion next month, 100 billion next month. So then the next month, it's another tail. Then it's another tail. And that's what you'd need, I think, to really have a bearish view on stocks, unfortunately. The fact that they'd be willing to stand aside in that manner.
I know you think that, the bond markets, there's a lot to be concerned about without question. So here's the way I'm looking at the world, okay? The best thing that happened to the market last year, somewhat counterintuitively, but it makes sense, was the failure of Silicon Valley Bank and then the subsequent failures that we saw for a myriad of different reasons. What's going on now over the last few months, all this geopolitical risk, is bullish for treasuries. In other words, there's a flight to quality in the form of treasuries. I think what's happened with New York Community Bank is one of the reasons we've seen yields on the margins go lower from here. I think yields would be higher, but for that, over the next year, I think, and please correct me if I'm wrong, close to $9 trillion of government debt matures. China has their own issues. I think we're all aware of what's going on there. Japan clearly has their own issues. So my question to you, I guess, who is the incremental buyer of the $9 trillion-ish of effectively debt that's going to need to be issued-ish over the next year or so? And how does that play out?
I think it's one of these questions that has a huge asterisk or condition attached to it, and that huge condition or asterisk is, what's the level of the dollar? Because if the dollar's here or higher, there really is no marginal buyer, and yields are going to go up at the long end until we find that. And the problem is, we know that at 5%, it doesn't work for anybody because our debt and deficits are too high. And then you risk getting into that debt spiral dynamic, which in the short run would be terrible for risk, but would ultimately, unless they stand aside, be willing to, they would have to stand aside. Otherwise, they're going to come in with some sort of liquidity to sort of calm that down. If you get the dollar lower from here, paradoxically, you would think that that would be inflationary. It will be on a leg, and that it would be bad for bonds as a result. But we know it's not. In the short run, it is absolutely not. We know that because we just saw it happen. The dollar went from 107 to 102, 103, and the 10-year went from 5 to 375. Some of that is just due to technicalities of sort of where FX hedged 10-year treasuries are yielding, right? So if you look at the FX hedged yield on a 10-year treasury for a Japanese investor, last week it was still like negative 2.6%. They're better off buying JGBs. And you can kind of see this post 2020. If you run a chart of the yen dollar cross against the 10-year treasury yield, like the correlation's like 1. The dollar gets stronger. Foreigners have $13 trillion in debt. Stronger dollar slows the global economy. $13 trillion of dollar-denominated debt around the world. They also own $7.6 trillion of treasuries. So if the dollar gets too strong, they need dollars to service dollar-denominated debt. They sell treasuries. U.S. banks, they've got $4.2 trillion of duration between treasuries and MBS. They will sell that if they need dollars. So again, if the dollar gets too strong, they're going to be selling alongside foreigners, alongside Yellen for her $1.5 to $2 trillion net deficit and her almost $9 trillion in refinancing. So you tell me what the dollar does, and I'll tell you what yields do. The dollar goes down. I think the long end of the yield curve will stay relatively contained. I think markets will be okay. The dollar goes up from here. Katie bar the door. We're going to go right back to the third quarter 2013 because foreigners will be selling, banks will be selling, Yellen will be selling, Yellen will be refinancing. I don't know who the buyers. Powell will be selling. There's nobody with the balance sheet to take the other side of that at these prices. And we know, okay, great. It's a price sensitivity issue, but we know at 5%, the wheels come off the car. So if the dollar gets too high, yield 10 years going back to 5, and then they're going to come in with more liquidity, or unless they're willing to stand aside.
Luke, can you explain, maybe dumb it down a little bit for our listeners/viewers here? Real interest rates, that 2% spread that you talk about, I think between real and nominal or whatever. When you get to that 2% level, why that is such an important point and why it's such a trigger in the markets, and just maybe explain that, because I think that's lost on people.
And so real interest rates are just what your nominal minus whatever your inflation is, right? So positive real interest rate of 2% implies that you're getting 2 points more than inflation in terms of the yield on the bond. Why that's important, there's a white paper by Charles Calamares. He wrote it last June, St. Louis Fed. It's out there in the wild. I'd encourage people to track it down. He pointed out that if the U.S. or global real rates got to 2%, if U.S. got to 2% real rates, positive real rates, it would put the U.S. into a fiscal dominance position almost immediately. Fiscal dominance is, to oversimplify, the point where the United States cannot afford its true interest-like obligations without either printing the money or negative real interest rates. If you look at entitlements plus gross interest expense, once you get to 2%, positive 2% real rates, you end up in a situation where your receipts don't cover that, and you either have to print or you have to default, and they print. But the point is, fiscal dominance is the fiscal situation is determining your monetary policy, not your monetary policy on whether you want to fight inflation or whether you're happy with unemployment, et cetera. So it's. I'm sorry. Go ahead.
We're back under 2 at this moment, right? I don't know what exactly you're looking. I would call it 1.6. I don't know where we are exactly, but I guess what I'm asking is, we talked. I asked you early on in this interview, what should people be watching? And obviously, if real interest rates move higher, if that gap goes back to 2 or north, what happened when it got to 2 last time? I was saying the bond market started to crack, right? So I guess you could either have you can have inflation move its way back up and narrow the spread, or you can have inflation drop down, but real interest rates stay high and that widens it. I guess what I'm saying is, what's the more important thing we should be looking for? Sorry.
It's a great question. I don't know which is more important, because ultimately it's sort of 6 of one or half dozen of the other in terms of the reaction, right? However you get to so if you get to 2, you're going to have a bond market issue. We know that. And then that's risk off for a moment, and then they come in with more dollar liquidity. If you go in the other direction, then you end up with real rates too low, and inflation comes back on a lag. And when that happens, you lose the long end. And it's a really, really important point that you raised that I think is still wildly underappreciated in markets, which is, there's this window of 2%. If they lose control of the long end at positive 2% real rates, and I don't know what the real rate is where you start to see inflation pick back up. I don't know if it's 1 positive, or if it's 0, or if it's -1, but it's not that far from here either. And if inflation picks back up, you're going to lose the long end too. So it's one of these situations we're not quite there yet, but we are quickly moving toward, because the window closes really as the debt rises, right? The more leverage you have, the shorter, the smaller that window is going to be, between losing the long end because of positive and losing the long end because of inflation. But it sets up a situation over the next, I think it probably comes in the next 9 to 18 months, where the only choice the Fed has is not whether they want inflation or deflation, but whether they want to lose the long end of the Treasury curve by tightening or by loosening. Because either choice, they're going to lose the long end. And that's where, paradoxically, I think markets, S&P, industrials, gold, Bitcoin, stocks, I think they all go up and to the right at a 45-degree angle as we near that moment. Because I think that is the smart play, because if we assign, as we near that moment, you have to decide. It brings everything down to one decision. Will Powell and Yellen stand aside and let the long end go, no matter what that implies for funding defense, funding entitlements, and Treasury expense? Or whenever, as we near the moment where they're going to lose the long end, whether they inflate or deflate, are they going to come in and do yield curve control or some version of it? And away we go. And to me, if I'm a betting man, if I'm looking at how I want to allocate my capital, I go back in history. There has been, that I'm aware of, no government with a purely fiat currency that it prints that has willingly not printed the money and instead shrunk the size of itself to preserve the value of its fiat currency denominated bonds. So does that mean I put 100% weight that they're going to print the money or yield curve control as we near that moment? No, but I would probably put it at 90%, 80%. And in our business, as you guys know, you don't get 80, 90% shots very often.
All right. So let's play this out, continue down this interest rate thing. We've reached February. I believe, at least of what I've read, we are now, in terms of duration, the longest inversion we've seen since they started looking at these types of things. And historically, and maybe there's not enough data to back up what I'm about to say, but historically, again, a steepening of this length or, durations along these lines have led to some pretty significant downturns. And as a number of people said, it's not the inversion that gets you, it's the re-steepening. And we got close, I guess. I think 2 years versus 30 years flattened out. 2s, 10s got down to about 13 basis points inversions, and we're basically re-inverting now. What are your thoughts on this entire yield curve thing? Like, how are you looking at this?
I very much agree and respect the message of the yield curve. I've been doing this too long to not. And we're also in a period where we have never been in terms of Fed balance sheet, U.S. fiscal situation, deficits for this level of unemployment, geopolitical derivatives, some of what we're seeing in energy, et cetera. And maybe to simplify that, we've never been in a position where a recession in the post-war era, we've never been in an era or in a situation where a recession will touch off a debt spiral for the United States of America, the reserve currency issuer of the world. And so that, when people say, well, it's never different this time, sometimes there are some things that are different. And that's one of the things that are different this time. We have a recession. That's going to blow that positive, the real rate number way above 2, right? That we were just talking about by virtue of deflation. You're going to get deflation relative to where rates are. Okay, your positive real rate. Let's talk about what that means. Okay, last 3 recessions in this country, 01, 08, 20, we saw a U.S. deficit from trough to peak rise between 6%, 600 basis points, 800 basis points, and 1,200 basis points, right? So in 01, deficit widened by 600 basis points, 08 by 800 basis points, in 2020 by 1,200 basis points, trough to peak. So let's add 600 basis points. Let's be really conservative. We're running 8% deficits now, 7% deficits now. We add 6. If we just get like a little baby recession like we had in 01, that's a 13% fiscal deficit. And the dollar, so you're going to need to finance 13% of GDP, $3.1, $3.2 trillion deficit. Low case, up to $5 trillion deficit under the worst case, which I think we can take off the table because we shut down a third of the economy, whatever COVID. $3 trillion, 13%. But again, remember the math before of the dollar tends to go up, at least in the early, into a recession until there's some sort of response. And the dollar going up is going to, so $3 trillion is going to be the net. Banks are going to have credit losses in a recession, and they're sitting on $4.2 trillion in duration that in theory, they're going to need to sell to raise dollars. Foreigners, $13 trillion in debt, dollar up, squeezed, $7.5 trillion in treasuries to sell. The refinancing. So you quickly can see, like, oh my gosh, there's nobody with the balance sheet in a recession. Like, it's 13 trillion, or excuse me, 13% deficit GDP. It would be by far the biggest since World War II. And so it's weird. In a recession, we could actually get like a significant re-steepening because there's just the supply-demand dynamics in terms of balance sheet capacity to buy all of the net effective issuance gets so imbalanced so quickly. So that's why I think there's this why it's difficult to fully play out exactly. I mean, you can see here, you can see there. How we get from here to there, we can have debates. I don't think here to there is going to last very long at all. I think you get, a week or two of the treasury market throwing up all over itself in a recession, yields going up in a recession, which of course nobody has ever seen in any of our careers. Now, you talk to EM people like, oh yeah, that happens all the time. It just happened in Turkey, happened in Argentina, et cetera, et cetera. That's what we'd be looking at. And so I'm kind of stream of consciousness thinking out loud, but that's how I've been thinking about sort of this inversion. What does it mean for recession? Okay, but then what does a recession mean given this debt deficit? And then this dynamic where we sort of plugged everybody with treasuries over the last 10 years from a regulatory standpoint that would all turn sellers with a stronger dollar in a recession.
Luke, I have a two-part question here. Part of the bullish thesis in general is that money will come out of money market and find its way into the stock market. So I'm wondering, first question is, what is that actual catalyst mechanism that makes people want to take money out and chase? The second is, there's not a lot of price discovery, obviously, in the equity market right now. We have large cap companies that are moving 120 billion at a clip, 150 at a clip. Okay, so the quarters are fine, but it's not that good. Re-underwriting these companies much higher. And my third part, or second part to the second question is, you mentioned, which I think is a good thing, kind of the virtuous cycle of the wealth effect of, as people make money in the stock market, tax receipts come in, it lowers our deficit, all that stuff that you would expect. The opposite's true when it goes the other direction. So we try to fill in the blanks and use that as a reason to say the markets, but if you could just take those, I'd love to get your thoughts on those.
Let's call it $6 trillion, give or take, sitting in money markets, cash, et cetera, I think can be a catalyst, but I think the catalyst for that, right? I mean, they're getting paid nicely, right? Whatever it is, 5.25. So I don't think it's going to move until until a quorum of market participants have the aha moment that I think they're going to have over the next 18 months, give or take, which is, oh my gosh, the US does have a fiscal problem. Oh my gosh, the Fed is loosening. The Fed, the United States is in fiscal dominance. The Fed is acting to finance fiscal deficits because they have to. And when that becomes consensus, and I think it will, barring a productivity miracle, that's when there's an aha moment of, oh God, 5% isn't enough. I need to be in something that better is going to participate in what must happen now. That's what I think the catalyst is for that. In terms of the second question about receipts, remind me again what.
Well, both the price discovery or lack of price discovery in equity markets, the chase, coinciding that with stocks are up. It's a virtuous cycle for tax receipts, and it helps, obviously, the budget for the U.S. So that can quickly go the other way. So is that a sustainable thing to be looking at? That seems somewhat ephemeral, I guess is what I'm asking.
The short answer is no, it's not sustainable, but it's a little bit like, I'm a big Guns N' Roses guy. It's a little bit like Mr. Brownstone. I used to do a little, but the little wouldn't do it. So the little got more and more, which is, of course, about a heroin addiction. And it's kind of the same thing here, which is to say, we know now empirically, because we just watched it happen in 2020, 2021, they drove an everything bubble and tax receipts went up like 40% year over year. And the deficit collapsed. And then Powell tightened, in my opinion, way too soon. He should have let inflation run hotter for longer to get debt to GDP down. Politically, he couldn't, he didn't, whatever. Okay, we can see the other side. He tightened, asset prices fell, unemployment never really moved. And yet the deficit blew out, it doubled. It went from 1 trillion to 2 trillion in a year, which surprised a lot of Washington economists. Last fall, the Washington Post, Jason Furman, they're all going, whoa, Jeff Stein, 2 trillion deficit. It was just 1 trillion last year. Biden was making so much progress. What happened here? This is really bad. And to me, it was like the least surprising thing in the world. Like you can see in the IRS data going back to really 95, but just run year over year U.S. federal receipts against year over year total equity market cap or total, S&P 500. And stocks lead receipts. They are the key marginal driver to marginal tax receipts. And so we had this massive COVID deficit. we generated an everything bubble. So it went from whatever $3 trillion deficit down to $1 trillion deficit in record time by virtue of the receipt bubble. Then when Powell ended that by raising rates and tightening, we saw the deficit blow right back out, pushed us right back into fiscal dominance. And so here we are again. Is it sustainable? Yes and no. Yes, from the standpoint that there's nothing stopping Yellen from weakening the dollar, Powell from cutting rates. Well, there's inflation, there's fear of inflation. That's ultimately it. It's sort of their credibility on inflation. And bigger picture, I think what they're really afraid of is having to buy the bond market, right? The yield curve control for them is sort of Hotel California. They end up buying a lot of the bond market. It's very inflationary, whatever. That's where I think this ultimately ends up. But they can run this iteration again. I think they're going to have to run this iteration again this year. And given what we saw last year, I think receipts are actually going to be okay next couple of quarters for exactly the reason we just described. But it's one of these things. I used to do a little, but the little wouldn't do it. The bubble's got to get bigger and bigger and bigger to keep it going. And at some point in that process, the $6 trillion sitting in money market fund goes, oh, wait a second. I'm the sucker at the card table. And sort of, every boomer with 40% of their money in long-term treasuries. So wait a second. I'm the sucker at the card table. The equity market's up 30 and I'm up 5 or 6. Like this sucks. And all right, take it out of the right. And they sell the bond market, they sell the cash back to presumably the Fed. I don't know. But that's the process we're now in. They let the system evolve this way. They wanted this system of stocks driving marginal receipts, and now they're getting it good and hard.
We weren't going to get out of here before we asked you about gold, and you alluded to it earlier, but in 2022, central banks bought, and don't at me if I'm off by a ton or two, I think 1,171 tons of gold, roughly $70.3 billion. I thought they were going to surpass it in 23. They did not. They fell a little bit short, but effectively the same amount of gold has been purchased by central banks in 23 as they did in 22. Here we are in 2024. You wouldn't know it by the price, although it's hung in there rather well, I would submit, given the fact that we've seen yields move and the dollar move and all those different things. Does gold have its day in 2024?
I think yes, because I think the dollar they're going to have to run this machinery of regenerating liquidity to keep control of the long end, to keep all the balls in the air of entitlements, defense, interest in an election year in particular. And so I think we see a weaker dollar through, not radically so, but a weaker dollar through 2024. And I think the Fed stops hiking and probably cuts a few times. And I think that ends up being really good for gold. I mean, I wouldn't be surprised if we see gold, mid to, 2,500, 2,600 at some point later this year.
That's going to tell an interesting story if, in fact, gold gets there. I'm with you, by the way. It's pretty incredible how poorly the mining stocks have done on a broader market that's done well and on a commodity that's done as well, too. It's just interesting to see these things play out. But, folks, you should follow Luke Gromen at Luke Gromen on Twitter. He is one of the few must-follows out there. I'm thrilled you came back with us. We'll absolutely have you back again. Luke, thanks for joining us here on the tape.
Thank you both for having me on. I really enjoyed talking with you and really appreciate the kind words.
Come back to the dark side. All right, Luke. We'll talk to you soon.